An electric car revolution shaped by trade tensions. The U.S. is losing ground to China in the global EV race. To catch up, it's pouring money into the car industry, but only for its closest trading partners. Now, the best chance to clean up U.S. auto emissions hinges on car makers building new local supply chains quickly.
It's good to have goals. It's good to be ambitious, but we really can't lose sight of ground realities.
In this episode of Transforming Business, we'll look at the massive U.S. subsidy program for EVs, the race to build electric vehicles across the continent, and how growing trade disputes could actually slow the decarbonization of the U.S. and global car markets. Our question: can North America launch its own electric car revolution? And we begin here in Spartanburg, South Carolina. Since the early 1990s, home to the largest U.S. production facility for German carmaker BMW. It turns out some 1,500 cars daily, and that in the middle of a transformation. A $1 billion expansion is preparing the factory for new electric vehicle assembly lines. BMW wants half of its car sales to be electric by 2030. It's just one of many car makers announcing big investments across North America. Ford, GM, Toyota, and Honda have all pledged billions of dollars on new battery production across the U.S. In Mexico, meanwhile, Volkswagen, Audi, Peugeot, and Fiat have released expansion plans to their factories. Tesla, meanwhile, says it's building an entire new facility in Mexico. Each of those announcements coming after U.S. President Joe Biden signed the Inflation Reduction Act in summer 2022. It's the largest climate legislation in U.S. history, offering a staggering $370 billion in subsidies for renewables, energy grid improvements, and mobility. Transportation is the biggest source of greenhouse gases in the U.S., accounting for almost a third of all emissions. The U.S. transition to electric has slowed, meanwhile. Both China and the EU have put more electric cars on their roadways in recent years and at faster rates. The IRA now sets ambitious new goals for electric vehicles, including that they reach 50% market share in the U.S. by 2030. Now, that's compared to only 8% last year. The law's central lever is a clean vehicle tax credit of $7,500 for buyers of qualifying new electric vehicles over the next 10 years. It's a massive incentive for consumers to buy only those cars that meet the requirements and for producers to adhere closely to sourcing rules. But more on that in a moment. For the North American car industry, the credit is a real boost, and it comes at a significant moment. Recently, it's been Chinese companies that have shown more tempo in the EV market.
Given that it's that signal to the overall EV supply chain here, there's interest, there is excitement. So interest, excitement, that means there's investment.
Alone in the first 3 months of the new law, car makers invested an estimated $33 billion just in the U.S. That's according to the Center for Automotive Research. It's investment that builds on a well-established production chain stretching across North America, the groundwork for which was laid some 30 years ago. That's when the U.S., Mexico, and Canada signed the North American Free Trade Agreement. The three nations believing that lowering trade barriers would create more prosperity for all of them. But opposition to the measure was high. Auto worker unions in particular were concerned about foreign products creeping into the supply chain and eroding the domestic production base. So they pushed for a sourcing rule. Some 62.5% of the total value of the vehicle had to be produced in North America. NAFTA essentially created an auto production chain that stretched from one end of the continent to the other and turned Mexico into one of the world's automotive heavyweights. The Mexican automotive industry is at the same technological level as the international automotive industry. In fact, Mexico is the sixth largest automobile producer in the world. There are 24 plants assembling cars or components for the major automotive brands in Mexico, and all of them are preparing in varying degrees to integrate into production of electric cars.
Con mayor o menor velocidad para integrarse a la producción de automóviles eléctricos.
The controversy over NAFTA led to further changes meanwhile. U.S. President Donald Trump, a critic of the agreement, renegotiated it in 2020. He raised the local sourcing requirements once again, this time to 75% of the car's value. In other words, despite the skepticism around NAFTA, the latest changes didn't substantially alter the supply and production chains across the continent. The new American law, the IRA, also has sourcing requirements, the ones we mentioned earlier. But despite North American supply chains having grown closer together over the decades, meeting the new rules is still going to be a stretch for car makers. And that's because of the complexities surrounding battery sourcing and production. It's a little complicated, but listen to this. To qualify for the full $7,500 subsidy, 50% of the vehicle's battery components, think of the battery cell or the collection of anodes and cathodes, must come from North America or one of the other 20 countries with which the US has a free trade agreement. That percentage then rises each year by 10% until reaching 100% by 2029. The other part of the vehicle credit depends on the critical minerals that make up those components, the copper, nickel, graphite, and cobalt, for example. This year, 40% must originate from North America, or again, other free trade countries, and that figure also rises by 10% annually, before topping out at 80%. Another challenge for automakers, final assembly of all vehicles must take place in North America, or in another free trade partner of the US. And then beginning in 2025, the new law prohibits sourcing components and minerals from China altogether. And that's a problem. China is the world leader in lithium-ion battery manufacturing, accounting for 79% of total production capacity. The US pales in comparison, and that's just lithium. Finding alternative sources won't be easy. The US has some critical mineral deposits, as do free trade partners like Canada, Australia, and Chile, but experts say most nations are still at the earliest stages of extracting and refining, and it's a process that's actually quite dirty and complicated.
So we're not looking at any quick solution for this key element in the whole battery process if we simultaneously insist we're not going to do business with China.
Car makers in the European Union and Japan, neither of which has a free trade agreement with the US, are especially critical of the assembly and sourcing requirements. But all car makers are likely to struggle with the rules.
The electric vehicle industry, it's vast. It has a lot of stakeholders involved. And you need all of those stakeholders, all hands on the table, as they say, right, for a transition. So in that respect, once you get a more complicated credit, it's tougher to see how fast that transition can go.
Companies are dealing with more than just sourcing problems. Retraining entire workforces and finding new workers while still meeting IRA timelines is going to be difficult. At the BMW plant in Spartanburg, training is a central part of the transition to electric. Last year, the car maker opened a $20 million facility for hands-on courses in robotics and electrification. The switch from internal combustion engines to electric drives isn't a small change, experts say, touching virtually every aspect of the vehicle and production.
The vehicle is designed differently, it's built differently. All the things about how the vehicle is built all the way through the process, even handling the different components, what required is in order to handle them. So we also have training for our logistics colleagues, for everybody that touches a piece of the car that could be impacted by the change from internal combustion to high voltage. All the way through to the operation of the vehicle, the testing of the vehicle.
From Japan to India and the US, getting workers like these ready in time is a massive challenge, especially if companies want to get the most out of the IRA.
I think it is very, very urgent. If there's something that I think cannot be disputed, it's how fast the transition has accelerated in the past couple of years, and especially last year, as I mentioned. There are huge policy pieces, such as the Inflation Reduction Act, but also in Europe, in other places around the world, a lot of policies really pushing for electrification of the industry across segments. So that means that over the next 3 to 5 years, companies really need to do everything in their power to be able to fulfill production targets that they have set out. And for that, again, they need the people.
A larger question looms in the background. Fewer workers are ultimately needed in the production process for an electric car compared to a traditional car. Even as companies retrain many current workers, there likely won't be enough jobs for the same workforce in the future. Studies vary on exactly what that will mean for the current workforce and whether that transition will happen through normal turnover or if it will be more abrupt.
It depends on how fast electric vehicles come in, but will the shrinkage take place to what I would say normal retirement and exit, or will it be so fast that you're going to have, real layoffs?
Whether automakers in North America can truly supercharge electric production will hinge on questions like labor and sourcing. And that in turn will determine how quickly the US can decarbonize its auto sector. The Independent Center for Automotive Research warned that the IRA may in fact hinder the EV market, citing supply chain and regulations. In other words, the best chance yet for the U.S. to transform its auto sector might be undermined by the very design of the program. And it's no accident that those rules are there. The U.S., like many other nations, is racing to support its own industries, driven by changing technologies, global competition, and of course, domestic politics.
Today, if you want an electric vehicle with a long range, you can buy one made in America. If you want one that charges quickly, buy American. You want one that's fast in the quarter mile, buy American.
But at a time when every electric auto is important, limiting choice comes with consequences.
This is just another brand of Buy America. First, it's more costly, and the evidence on that is very strong. And secondly, the delays. And in this particular area, I think the delays will be significant. So that fights against the decarbonization aspect of this whole IRA initiative.
For car makers, the new push by Washington is simply good business. North America, a good investment. But it's also an example of how the political priorities in one country can conflict with broader climate goals.